In this video, I'm going to be sharing with you what an alternative investment is, how to differentiate it from other types of investment, and why they will become increasingly important to your own wealth, and why you should care. This is an alternative investment, as is this, and this. If someone were to say to you what an investment looked like, what would you say? Would it be gold, a business, or the stock market? Leave a comment below as to what you think it is now, and come back to it at the end of the video, and see whether it's the same. At its most basic level, an investment can be considered deferred consumption, foregoing consumption now in the hope of greater consumption later. Though exactly how you defer that consumption, through what you put your money in, is key. In a nutshell, investments can be split between those we consider traditional investments and those we consider alternative investments, otherwise known as alts. Traditional investments can be broken down into three main categories: fixed income, such as bonds for example, publicly traded equities, such as shares in the stock market, and cash. Of these categories, fixed income makes up the largest amount, followed by equities, with cash as the smallest share of the pie. As we can see, traditional investments are commonly comprised of equities and bonds, a form of fixed income. Taking a second to explain these, equities are akin to a publicly traded stake in something, such as shares in a company, and bonds, at their most basic, are just basically the debt which an entity borrows from a person, company or institution, in exchange for a promise to repay the initial amount borrowed, known as the principal, plus any interest. These traditional investment classes are very important, as they account for the vast proportion of global wealth. In fact, it wasn't too long ago that your standard traditional portfolio, such as your pension for example, would be split between equities and bonds. However, this isn't supposed to be a video about traditional investments. Focusing only on traditional investments would be akin to viewing the Mona Lisa through a microscope. You would be depriving yourself of a much wider economic landscape. This landscape is made up of everything we would consider alternatives, or otherwise known as alts. There is no one universal definition, though the industry leader in alternatives education, the Chartered Alternative Investment Analysts Association, or CAIA for short, has defined an alternative investment as any investment that is not simply a long position in traditional investments. This type of exclusionary based definition is vague on purpose, as alts come in all different shapes and sizes. To help conceptualize this, alternatives can be split into several main groupings. If we take a look at the global investable market for these groups, they would account for these weightings you see on screen now. Tallying all these categories up equates to a total alt investment market globally of about $13.4 trillion. As you can see, the market is dominated by private equity and hedge funds. Now, taking a second to describe these two in a little more detail. Private equity is an ownership interest in an entity that is not traded, whilst hedge funds are a form of partnership between a managing partner, who manages a pot of money, and limited partners, who contribute capital to the fund but leave the day-to-day decisions to the managing partner. To put the market for alts in context, the total market for traditional assets is believed to be just over $100 trillion. This dwarfs the market for alts. Taking a look at this pie chart helps to put things in perspective, where alts make up only 12% of the global investable market. So granted, alts are a small proportion of the global investable market. However, they are a growing segment of the market. Alts have already doubled from 6% in 2004, and according to a survey of 1,000 CAIA members, alts' share of the investment pie is expected to grow to somewhere between 18 to 24% by 2025. All of this suggests that alts are of significant and growing value, since they have doubled in size since 2004 to be more than a tenth of the market to date, are back to be up to a quarter of the market in the next 5 years, and will no doubt continue to grow in importance beyond 2025. However, why should the average person outside of a hedge fund or private equity house care about alts at all? The answer to this is actually twofold. Firstly, changes in technology will mean alts will make up an ever greater share of investable products. Fractional ownership, the growth of the retail consumer market, the internet, and cryptocurrencies will all have their part to play. And secondly, pension funds. And this is a big one. Pension funds in many parts of the globe have been running deficits for years and are therefore continuously looking to diversify their portfolios and seek ever greater returns, with alts offering the perfect platform to achieve this. The UK government's advisory group for Parliament on pension funds has suggested low returns in traditional markets are making alts a more attractive option. According to the group, over the last 20 years, for a UK investor, Global equity returns have averaged 8%, and UK government bonds 6.5%. A classic 60-40 balanced portfolio between the two would have returned over 7% per year. Over the next decade though, modelling suggests a return of 3% per year is a realistic expectation. What this suggests is that the average return of your traditional assets will decline by about 4% over the next couple of years. However, the group goes on to suggest that by including a much wider range of assets and diversifying more aggressively, provides a route for investors to do significantly better. The group expects a diversified liquid portfolio to achieve 5 to 6% per year and 7 to 8% for those who can allocate to good private equity and debt funds. Statements like this only go to highlight the problem traditional investments are facing and the unique and beneficial role that alts can play. In effect, returns and wealth creation are already and will be increasingly driven by alts. This drive towards alts is further driven by lower interest rates. Even before the current crisis caused by the coronavirus led to record low interest rates and quantitative easing, a topic we will be covering in a future video, the last 2 decades have seen global interest rates move to record low levels. Therefore, the perception of alts as a potential knight in shining armour is a key driver of the industry.